Inflation continues to be top of mind for many investors, and last week's consumer price index jumped by the most in over 30 years in October compared to the same month last year. But at least one regional Fed president is saying the Federal Reserve should not overreact to elevated inflation. We're bringing in Yahoo Finance Fed correspondent Brian Cheung for more. And Brian, yesterday, Minneapolis Fed President Neel Kashkari, who we should note is not a voting member of this year's FOMC, did seem to double down on this notion that current levels of inflation will be transitory. What else did Kashkari have to say, and how prevalent is his view among members of the FOMC?
Well, in terms of policy, what Kashkari was saying was that the Federal Reserve shouldn't move to tighten just because you got one hot print on the consumer price index. As you mentioned, that reading that we got on a year-over-year basis, clocking in the fastest that we've seen in about 3 decades. But in an interview with CBS, I believe it was, he said that his view is to, quote, not overreact to some of these temporary factors, even though the pain is real. And this is a talking point that we've heard the Fed chairman Jerome Powell himself use as well, with the Federal Reserve insisting earlier in the year that inflationary pressures were going to be high and maybe eye-poppingly high, but that they would eventually abate. Obviously, now we're many months, almost a year into high inflation readings. That's testing the resolve of Federal Reserve officials to insist that these types of things are transitory. Now, Kashkari added that he feels like these high inflation prints will likely last through the next few months. And in fact, other Fed officials have said we should expect to see hot inflationary prints through even the beginning of next year. But of course, the transitory view, at least for now, still remains the prevailing thesis for the Federal Reserve, which has insisted it can continue to keep interest rates at near zero, at least through the beginning or the middle of next year.
And Brian, we're also awaiting official word from President Joe Biden over who will be his pick for the next Federal Reserve chair. What do we know so far about how that decision is shaping up?
Well, based off of the chatter that we've heard so far, it really is a horse race, at least for the Fed chair spot, the top spot at the central bank, between 2 people. That's incumbent Fed Chairman Jay Powell and then existing Fed Governor Lael Brainerd. Now, both of them did reportedly visit the White House, but we have to remember it's November 15th now. We are way behind schedule when it comes to previous Fed chair announcements. Here's a little bit of history for you. If you rewind to the Bush administration, they had announced their pick of Ben Bernanke as soon as the later part of October. Actually, in 2009, Obama, when he nominated Bernanke for a second term, did it as early as the end of August. And then October was when Obama picked Janet Yellen. And then the Trump administration announced that Powell was going to be their pick in early November of 2017, which by standards at that time seemed to be pretty late. Obviously, the Biden administration now making a name for itself as being even later than that. I want to also emphasize we haven't even heard any sort of teasing from the White House about an announcement coming at any point in time. Recall that the Trump administration actually released a trailer for their Fed chair nomination announcement. The president, of course, at the time, using Twitter to tease his Fed chair announcement a few days before that November 2nd announcement. We're not getting anything from the Biden administration in terms of timing. But again, headed towards the Thanksgiving break for Congress, who the Senate would have to approve any pick that they have. So it seems like they don't have much time to get an announcement out there.
Yes, Brian, almost weird to contemplate that it's been over a year that we haven't had the pageantry of the Trump administration and their press releases. But I want to take a step back here, Brian, because we got another minute or so. And in your perusal, in your interviews with these various Fed officials, are you seeing any kind of change in language? I know that at the FOMC, when they drop their announcement, their decision, you can perform a red line version and see what they're thinking there. But I'm just wondering, in this context of the speeches and everything else, is there some kind of trend that you can identify?
Maybe a little bit. I mean, for right now, as I kind of emphasized with the remarks about Minneapolis Fed President Neel Kashkari, they're still leaning on the T word, transitory, and that's codified in the FOMC policy statement. It's the official statement of the voting member committee that they feel that these inflationary pressures will at some point abate. But there's an admission, and a pretty clear admission among all these Fed officials, that the transitory argument is definitely being tested at a level of stress that they had not anticipated when they first started using the T word in the spring of this year. And what you're starting to see is people still use the T word, but kind of slowly hedge their bets here. Consider, for example, Atlanta Fed President Raphael Bostic, who talked about the idea of at the Federal Reserve Bank of Atlanta, which he heads, putting $1 into a jar every time someone uses the T word, just to be mindful of the proper application of that word. Now, of course, this doesn't mean that they're necessarily balking on their use of the T word, but if these inflationary pressures do start to last through the beginning of next year, do you start to see some of these hawks fall out of using the T word and say, look, I think this is going to be permanent. We have to be more aggressive with our policy and removing this accommodation. That will be a very interesting thing to watch as we get into the early months of next year.